You have joined the meeting as an attendee and will be muted throughout the meeting until March 31st, 2023 of the remote meeting provisions of the March 12th, 2020 executive order suspending certain provisions of the open meeting law. All members of the committee will participate remotely via audio, video conferencing, and public access to the deliberations of the committee will likewise be provided via telephone, with all documents referenced at the meeting available to be viewed on PRIM's website, which is www.mapension.com. All persons speaking at today's meeting are asked first to identify themselves. Also, the open meeting law requires anyone wishing to record the meeting to first notify the chair so that the chair can inform the other attendees. No one has indicated the intention to record today's meeting, but if anyone does intend to record today's meeting, please first notify Seth Gattell by email at sgitl@mapension.com. Additionally, the Attorney General's guidance on holding remote meetings reads as follows. At the start of the meeting, the chair must announce the name of the member or members who are participating remotely. I will now announce the names of all investment committee members who are participating remotely in today's meeting. Myself, Deborah Goldberg, Chair, Leroy Brantley, Michael Evans, Connie Everson, Phil Perlmutter, Phil Rotner, Glenn Straley, and Timothy Vale. So we do have both bills today, so we're going to be sure to figure out how I'm going to differentiate them in the roll call vote. They follow each other too. So,
Roger?
Yes.
My apologies. I think I saw Ruth Ellen Fitch on.
Oh, well, yes. There you go, Ruth Ellen. Sorry about that. In here. Thank you.
And if I may interrupt, I'm sorry, Treasurer. I do have a couple late notices of recordings that I should probably make you aware of.
Okay.
Justin Mitchell from Funfire will be recording. Sarah Rundle from
From
Top
where?
1000.
What was the first one?
Justin Mitchell from Funfire.
Okay, thank you.
Sarah Rundle from Top 1000 Funds. And John Redefell, Quincy Taxpayers Association.
Okay.
Thank you.
All righty. Let's see. So we got, all right. And now we are ready for the first vote. So I would seek a motion. Just make sure I'm not screwing anything up. Yep. I would seek a motion that the investment committee approve the minutes of its November 15, 2022 meeting attached as Appendix A of the expanded agenda, and further to authorize the executive director to take all actions necessary to effectuate this vote. Is there a motion? So moved. Is there a second?
Second.
Any questions, comments, changes, anything at all? Hearing none, we will proceed. Leroy.
Yes.
Michael. Michael Evan.
Yes.
Connie.
Yeah.
Ruth Ellen. Yes. Bill P.
Yes.
Bill R. Philip Rotner.
I don't see him on the screen. I don't see him on the screen.
My notes tell me he'll be here at 10.
Oh, okay. Glenn.
Yes.
Tim.
Yes.
Myself, yes, the motion carries. Okay, next item on the agenda, the Executive Director, Chief Investment Officer report. Take it away, Michael.
Thank you very much, Treasurer. Hopefully everyone can hear me.
We can.
Excellent. Leroy, you're right. Paul Shanley has an incredible attendance record, but unfortunately he can't make it today because he is fighting an illness. Oh no! And we all wish him the very best. Right. Today, we're very pleased to report a significant improvement in the PRIT fund performance in the December 2022 quarter, and that follows 3 straight quarters of previous market declines, as you all know. The PRIT fund was up 4% for the December quarter to cap a very difficult year. I'll get to performance later today in more detail, but a reminder that last year at this meeting, we reported December 2021 quarterly results, and at that time, the results were up 5.4% net for the quarter, and for the calendar year 2021, you may remember, the fund was up more than 20% net. Calendar year 21 returns were the 4th largest returns in PRIM's entire history, and with outperformance of 8% in that year net of fees, that was the strongest ever outperformance in our entire history. And boy, what a difference a year makes. We've previously discussed how we should expect market drops and economic cycles to impact the PRIT fund periodically, and calendar 2022 was one of those years. Equity and bond indices were down globally. Domestic equities were down 18%. Developed international equities were down 14.5%, and emerging market equities were down 20%. And normally, we would expect bonds to offer some protection to a sell-off in equities, but even bonds were down substantially in calendar 2022. They were down roughly 13%. So that puts a 60-40 mix of stocks and bonds, a common benchmark. That was down 16.2% for the year, but the PRIT fund fared better. It was down 11.2% net of fees. You can't control market returns because we don't control things like geopolitical events, slowing economic growth worldwide, monetary policy response, wars, viruses, supply chain shortages, or the behavior of other investors. We are market takers, and the only thing we can really control is the design and the composition of the PRIT fund. And we have carefully engineered a diversified portfolio with components that will perform well in a variety of market environments. And we are also laser focused on controlling our costs. Our history of strong performance in both strong and weak markets is really an indication that our portfolio is well constructed in terms of risk, return, and cost. Those are the philosophical three pillars of PRIM's investment program. As you will see later today, our alternatives, specifically hedge funds, private equity, timberland, and real estate portfolios, really helped anchor the fund in the very stormy environment that I just described. An investment period, again, when both public equities and public bonds were down significantly in all markets around the globe. I said it last quarter, and I'll say it again, the fact that we do have a silver lining. And the silver lining is that market downturns create good buying opportunities. The PRIM team has been busy during the year evaluating opportunities and deploying approximately $5.7 billion in new investments. The other silver lining is that the December quarter was strong and positive, breaking again a three-quarter negative trend. And so far this year, the strength is continuing. In the month of January alone, equity markets are up between 4.5% and 10% globally. Bonds are approximately up 3%. And we hope the good trends continue. You'll be hearing from Connie later on her view of the markets. Customary for this board cycle would be reviewing asset allocation and annual plans. The annual plans, which again I will discuss later in the agenda, are largely consistent with prior years, but this year you will find a new effort under each functional area of PRIM to support the newly formed ESG committee. We believe this committee will build on the important work we have been doing internally and with our partners at the MIT Sloan School's Aggregate Confusion Project. We are excited to get started with a new committee, and we have recently reached out to the new committee members to schedule our customary on-board briefings. We expect the ESG committee's first meeting will occur at the next board cycle. On asset allocation, we'll recommend continuing our multi-year effort to gradually increase our allocation to private equity. Maintaining a consistent pace of private equity commitments has been a key contributor to our long-term success at PRIM. We have observed throughout our history that some of our highest performing private equity vintage years originate during volatile times just like this, when other investors may be cutting their commitments for a variety of reasons. Our private equity partners have the proven ability to wait for valuations of companies to become attractive to deploy capital. Said another way, investors who are able to provide capital in difficult environments invest when valuations are cheapest. That's a winning strategy. And we have learned that 80% of our peers are currently 4 to 6% above their ranges for private equity. 80% currently 4 to 6% above their ranges for private equity. But at 17% of PRIT fund assets as we sit here today, our private equity program is within the current range. And we have room to continue our commitment pace. And this deserves some recognition. As you know, Mike McGurr and the private equity team carefully model our commitment pacing each year. And the fact that we're still within our range when others are not is testimony to the robustness of PRIM's very disciplined annual process. You'll hear from him later on that. The recommendation you will vote on today is for a 1% additional allocation to private equity. This continues a multi-year trend that's consistent with our asset allocation research findings, and it will enable us extra headroom to maintain our commitment pace in private equity. You'll hear from Maria Garahan, our Director of Research, later today on asset allocation. Before providing more detail on performance, a quick organizational update. First, 2 new employees. Please join me in welcoming Peng Tuan Wu to PRIM. Peng Tuan joined our research team 2 weeks ago as an investment officer reporting to Maria Garahan. He holds a Master of Science degree in mathematical finance from Rutgers, and before coming to PRIM, he was a principal quantitative developer at Fidelity Investments. And at Fidelity, he helped lead the development of a centralized factor engine in addition to many other quantitative research initiatives. We are also pleased to report that our valued intern on the research team, Tiani Shi, will become a full-time member of the research team effective Monday, February 6th, and she again will report to Maria Garahan. Tiani joined PRIM as a research intern in May 2022, and she has worked within multiple areas of research, all while finishing her degree at Boston University. Most notably, she's worked on venture capital, a construction tool for venture capital, which seeks to identify an optimal range of funds per vintage year. Additionally, she's contributed significantly to this year's asset allocation work, which you'll hear about later today. In December, just a couple of months ago, Tiani graduated from Boston University with a Master of Science degree in mathematical finance and financial technology. She also has a bachelor's degree in financial engineering, and we're delighted that she chose PRIM to start her very promising career. So welcome to PRIM, both of you. We're very excited to have you. Next, an update on the Future Initiative. We announced earlier this month that PRIM deployed more than $2.8 billion to diverse managers in 2022, and that brings the total to more than $9 billion deployed. In December, PRIM received the Commonwealth's Equity and Governance Award for its efforts in this area, and PRIM also designated more than $340 million to 15 emerging diverse managers as part of a $1 billion program specifically designed to reduce barriers between the fund and emerging diverse managers. This progress was reported to the state legislature as required by the law, the investment equity legislation. You remember this legislation was championed by the treasurer more than 2 years ago. And as reported by Pensions and Investments, this puts PRIM, the $9 billion puts PRIM at the very top of the heap compared to other pension funds, 7th in the nation for the dollars at work with diverse investment managers, and that's far above our rank in size. turning back to PRIT fund performance, the December quarter was positive. The S&P was up 7.6%. Developed international markets were up more than 17%. Developed international markets are primarily Japan and Europe, up more than 17% in the December quarter. Emerging markets, which is primarily China, Southeast Asia, and South America, emerging markets were up nearly 10%. So this is the first time in a while that developed international and emerging markets outpaced U.S. returns for a quarter. And diversified bonds are up about 2%. This puts a 60-40 mix of stocks and bonds for the December quarter, up 6.6%, and the PRIT fund was up about 4% for that quarter. For the calendar year, just to review the year, calendar year 2022, the S&P 500 was down more than 18%. Developed international markets were down 14.5%. Emerging markets were down 20%. Bonds, as I mentioned, were down 13%, and a 60-40 mix, as I mentioned, down 16.2%. And the PRIT fund fared far better for the year. The PRIT fund was down 10.8% gross, 11.2% net for the year. Tony, the performance slide, please. Let me know when it's up. I can't see it. Starting with the fiscal year market value slide. Is that up? Yep, there it is. Okay, you can see from this slide that we ended the calendar year with $92 billion under management. That's essentially flat from the end of the fiscal year, which ended in June. But remember, we do pay benefits, and net outflows to pay benefits for the 12-month period ending in December were $738 million. 738. Ended at $92 billion. Next slide. You can see the PRIT fund total returns for the 12-month period down 10.8% gross or 11.2% net. That equates, unfortunately, to an investment loss of $11.6 billion net. And the chart really shows underperformance for the 12-month period. We'll be talking more about this. The underperformance was 3.8% gross or 4.2% net. There are two primary reasons for this, and both reasons we've discussed at length in prior periods. The first and largest component of the outperformance was related to the private equity benchmark. And just briefly, for a one-year period, we compare the actual one-year private equity return to a 7-year annualized average return for private equity. And as you can imagine, the 7-year annualized return includes some very good positive years, while the one-year number was more challenged. That's the largest component. The second largest component was the fact that the real estate benchmark is lagged. Unlagged, if we just received the unlagged benchmark just a few days ago, and it is down -5%. But in this comparison, our one-year reported December 2022 includes December 2021, which was up almost 8%. So when we unlag the benchmark, there's a 13% swing. So those things happen from time to time, particularly in volatile markets. Over time, they equalize, and we expect that going forward. You can also see the 3, 5, and 10-year numbers strong and above benchmark. Next slide. The one-year ended asset class performance summary. On the left, you can see that timberland and real estate were very strong positive contributors on an absolute basis. This is terrific news. And on the right, you can see what was challenged. Global equities, fixed income, as I mentioned, down very strongly, even value-added fixed income down. These are things you would expect when interest rates go up, bonds go down. And private equity for the 1 year period on this slide, we compare to itself. We'll get into, Mike McGurr will get into private equity performance in more detail later. Next slide. This is for the 1 year period performance by strategy. On the left, you can see again what did well. Timberland, real estate, and private debt did well. All other asset classes were down. U.S., international, emerging markets. Equities down a lot. Long duration fixed income on the far right, down almost 4%. Those are 30-year bonds or so. Long duration bonds, 20-year bonds, I should say, down almost 40%. But in the middle, you can see the PRIT fund down 10.8% gross, 11.2% net, compares very favorably to a 60-40 mix. Over on the right, a couple of bars down 16.2%. And for the quarter, next slide, please. Performance by strategy. The quarter was somewhat of a reversal of previous trends that I just reported on the 1 year slide. International stocks, the strongest in the quarter, reversing a trend that we witnessed for the prior 3 quarters. Alternatives lagged a bit, while they, for the 1 year period, outperformed. And you can see in the middle that the PRIT fund was up 4.1% versus a 60-40 mix, which was up 6.6%. And I'll end with the quilt chart, which shows really real estate, private equity, Timberland for the 1 year period, the #1 performing asset class, really adding stability to the fund over a very long period of time. Portfolio completion strategies, which is primarily hedge funds, 80% or more hedge funds, really contributing stability to the 1 year period. This is exactly what we expect from portfolio completion strategies and hedge funds. That's how our hedge funds are designed to provide stability in volatile equity markets. And last, you can see global equity volatility is quite large for a 1 year period near the bottom, and for the 10-year period, third from the top. A lot of volatility in global equities. Tony, you can take the performance slides down. So moving on to markets, we began pointing out a peak in bond yields and signs that inflation had begun to moderate 2 quarters ago, you may remember, at the board cycle in August. Connie Everson asserted last quarter that this development created a much better outlook for equity markets, and she was correct. The equity markets bottomed and are continuing to rise. Interest rates peaked in October, and the bond market has also begun to rise. As we sit here today, the markets appear to be beginning to discount the end of the Federal Reserve's aggressive tightening policy. They meet tomorrow. We'll see what they do. 25 basis points increase is what's expected. But the markets are beginning to perhaps discount even a reversal on the heels of data that suggests a cooling of the economy and moderating inflation. Of course, the main risks going forward are very familiar. The risks are that inflation spikes again or remains too high. After all, there are some significant geopolitical situations that could disrupt the supply chain yet again. Consumer and business spending, along with corporate earnings, could weaken more than anticipated, and unemployment or wages could spike. Any of those conditions could result in an economic slowdown that turns into a severe recession. A severe recession is not what's expected right now. In fact, I'll hold this up. Hopefully you can see it. But the consensus right now is for a very mild recession. 100% expect a mild recession according to this survey of investors. So there are still many moving pieces in the global economy, and obviously in the world's geopolitical situation. At this point, I'd like to turn it over to Connie for her latest observations. Connie.
Can I ask you a quick question on the portfolio, Michael? You mentioned the outperformance on the international long-only equity side of the equation, with both developed markets and emerging markets doing a little bit better than domestic equity. Do our managers in that part of the portfolio, I'm imagining this has something to do with the strength, the weakening of the dollar, providing a tailwind for the international equity pieces. Do our managers in that part of the portfolio hedge equity, or are they by mandate unhedged in that?
I believe we're mostly unhedged, but Mike McElroy, do you have a better answer on that?
Yeah, that's correct. Most are unhedged. Some will do some currency as part of their strategy, but generally it's bottom-up stock selection rather than currency overlay.
Thank you, Mike. Michaels.
Connie.
Hello, everyone. I suggest we talk about inflation, the economic situation, and the stock market outlook. And Tony, thank you. You'll see coming up a chart of U.S. CPI inflation. And we did talk about this. Indeed, Michael, you're so right. We met in August and November, and which was the second half of last year. And if you look just at those monthly changes in CPI inflation in the second half of the year, just that 6 months, that's a below 1% month-on-month inflation rate. And the economics suggest, just as you mentioned, Michael, that the December's -1 number was actually not a one-time fluke, and we could see more of that. The lingering pressure points on CPI are melting also, we're fading also. One of them is rent, shelter costs. You're familiar with the way the shelter component of CPI is calculated. It's an estimate of what you could charge for your own home if you had it on the market to be rented. And the problem with that as an inflation measure is properties that are sampled only every 6 months, and rental contracts tend to change only every 12 months. So the shelter component of CPI, which is still being listed at 9.98% for December, that's annualized, where what you see on this chart are monthly numbers, but that's reflecting year-ago conditions in housing, and current conditions in housing are the final 4 blue bars on this chart. This is from a report from a national apartment listing site, apartmentlist.com, and they report the December price change -0.8 or just below -1% price change for November, or for December, just that 1 month. Third largest monthly decline they've measured in 5 years, and the first and second largest monthly rent decline were the prior 2 months. So this, in other words, the shelter component of CPI, those numbers are about to look very different. As properties are sampled every 6 months. It's been 6 months now of easing inflation pressures, and this very likely will contribute to further easing. And then the other concern has to do with wages. The people are trying to draw a line between lingering high wages and inflation. But point one to be made is wage growth is easing also, 4.6% year over year for December for private employment. And the non-farm employment number is slowing also. That's the following chart, where that non-farm payrolls, now they're growing. This economy created many thousands of jobs last year, but at a slower pace by year end than certainly at the start of the year. And in any case, inflation actually can continue to ease a lot, even if wages do stay relatively high relative to history. They don't one-for-one translate into inflation. Wages don't. They have their impact through the service components. And even there, companies operating in service sectors can elect to necessarily their higher labor costs. Then there's the whole other goods side of the story, including energy, gasoline included, food. These prices have been easing, just not eggs, but in other respects. Other goods, the widely noted auto prices and used car prices, these are all far less impacted by wages. And when it comes to the economic situation or what's coming next, there are two things particularly to keep in mind. The larger half of the two, one of them is that economic deterioration actually started last year. It's not something that's about to start this year. It was mid-year last year. You may remember talking about an example of a forklift manufacturer that had prominently reported having to shut down production lines, some key production lines, for lack of critical components. But having done that, that's impact on that firm's own suppliers. For example, battery makers that were impacted themselves with unwanted inventory buildup. This was all being reported mid-year last year. That's grounds for an economic slowdown underway 6 months ago. That was the opportunity for inflation to stop accelerating and then finally start easing, which was the opportunity for bond yields to peak, as they finally did in time for the fourth quarter. Now, as for what comes next, people are trying to be so precise about, is it a mild recession? Is it a quasi-recession? Is it just a slowdown? And to be truthful, that distinction is not such a large distinction. If the GDP is slightly above or slightly below the zero line, that's not a large difference. Those are essentially the same and consistent with a stock market bottom. That much damage, for sure, has been discounted. An economic plunge in excess of what's been discounted already, that would be another matter, and so far not in the picture. What does bear watching is what's happening on these charts. The ISM manufacturing index, especially with its report on new orders, began to show contraction readings last mid-year, starting July, consistent with what we heard from that forklift manufacturer and others in the sector. What's new is this non-manufacturing orders picture. Starting December, you see on the left side, the non-manufacturing is services. That's employment, is really what you're talking when you see changes in non-manufacturing side of the ISM survey. So this decline suddenly in December from a reading that was pretty solidly into the 50s bears watching. From the perspective of the Fed, you just can't keep talking about jolts if this is happening in employment, which is what non-manufacturing really is. They'll look ridiculous. They really do. They may be talking about more rate hikes and keeping the Fed funds rate elevated indefinitely, but that's not what this chart's pointing to. And it's not what futures markets, for example, Eurodollar futures, it's not what they're pointing to either. That Eurodollar futures market has been fairly insistently pricing rate cuts, substantial ones starting mid-year. But to the question of, okay, does this mean the economy's moving into a more severe environment? It does bear watching, because employment tends to be the big difference between something of slowdown proportions and something worse. But keep in mind, it matters a lot, a big difference if the Fed backs off while the economy deteriorates compared to if the Fed continues to raise rates. So we'll see. But at the moment, the economic picture so far is not deteriorating to something that would require the stock market to discount worse than it has. Because then you come to the stock market itself. It began a bottoming process right as inflation pressures began to ease. Month on month, number became very different starting July, and no coincidence. You'd think that that's right as equity markets began to try to form a bottom. The link is the impact on bond yields if inflation pressures are easing. If inflation has peaked, which it did in June, then bond yields can peak, which they did a few months later, and that removes the largest risk of all for the stock market. If the Fed backs off, that's additionally helpful, but the case is already, or the outlook is already more decisively favorable for equities, because the easing in inflation is more decisively visible now. Now, there risks abound for sure. There's, of course, a risk of a worse economic outlook, risk of liquidity problems. We more severe. The risk of liquidity problems becomes more acute at year end when volumes are reduced, but it's still a risk we live with. The debt ceiling is not settled. That's one of multiple risks and threats that markets have to keep evaluating, but that's one that's that's commanding headlines at the moment. And then there's the outcome of this war. I mean, the main is the misery being caused by this war, but there also can be market consequences if it deteriorates sharply. But this, and then you come to the character of the upcoming cycle. Something that bears watching is the underlying fundamentals of the U.S. dollar. For now, if you look at and this is a question that Leroy mentioned, and no doubt managers are thinking about very frequently at the moment with the pullback in the dollar since October. Compare that to the left-hand side of the chart, which was May 2002 through July of 2008. It's represented as a decline in the dollar. Conditions in the U.S. were not so bad, but it was a growth rate for everyone, but particularly credit-fueled boom times overseas. That in the housing sector, it was boom times here also, but that credit flowed. That regional banks around the world could rely on funding through the repo markets, which gave them an opportunity to support any manner of projects, private and public. And that was and multiple currencies, multiple economies, and their stock markets performed extremely well for those 6 years. The euro, just as an example, rose from 86 cents to $1.64 during that time. Sustained outperformance of these other currencies. That was, you can see the difference starting 2008 when the U.S. dollar has dominated the crisis and the post-crisis environment, except for some interruptions. 2017 was an interruption where other currencies had an opportunity to make solid gains for just over a year, and that credit machine speeded up at the time. Also, says the Bank for International Settlements. This current pullback in the U.S. dollar is something for now we're rating as neutral, which means we don't have enough yet to say whether or not this is a May 02 type of turning point. What would determine that would be liquidity factors, such as use of the Fed's reverse repo facility and credit default swaps, high yield spreads, and other measures of risk aversion rising or falling in the funding system. Essentially, what you need to get at is how well U.S. dollar credit is flowing around the world, whether it's strained or not, because it was most certainly strained after 08. So not clear yet. Liquidity measures are improving a little. They are, especially from the slight deterioration they showed at year end. But they're not comparable to May 02 yet. So for now, we're thinking of this in the meantime as something similar to what happened in 2017 or 2020. Not a more durable turning point, but we'll see, because every new bull market has a character different from the one that preceded it. And so this is a candidate to be something very different in the potential candidate or opportunity for leadership in what's coming, as do sector choices. So we'll see. I'm leaving you with something that's not determined yet, but you can imagine we're all watching what happens to the dollar. Better put, what happens to the underlying fundamentals under the dollar. And am I leaving anything out you were hoping we'd spend time on?
So I guess your conclusion in all of this is that, falling inflation is going to make for a better equity market.
That was because of its impact on bond yields.
Yes, and some sort of decline in GDP activity, whether it's slightly positive or slightly negative, is already baked in.
Indeed. Indeed.
Okay, thank you.
That's because when you think about it, in the relative impact, what economic deterioration will do is negative for earnings. Certainly, you do have to think about that because the economy's deteriorating, but overwhelmingly, that's overruled by the impact of a bond yield peak and opportunity for bond yields to decline again.
Very good. Thank you, Connie.
This is an interesting conversation because on Thursday morning, I'm going to be the keynote speaker at Bond Buyers National Outlook. Now, the good news, Connie, is I learned that it's called the National Outlook, not the National Economic Outlook. And they asked me to, because Connie spent a good hour on the phone with me, prepping me on the economic outlook. And so I'm actually going to have a broader scope to what I speak about. But one thing I assure everyone up front is that they will hear from a lot of economists and practitioners on their opinions and ideas for the coming year. But what I can assure them with absolute certainty is that everything is uncertain. and that the actual name of my speech is what is it, Sue? It's a long title.
It's Common Sense Leadership Managing for the Long Term.
For the long term.
And you're speaking because they're giving you an award.
No, the award was last December. I now am on the bond buyer circuit. This is about the third or fourth thing I've done for them. But as I listened to Connie, what I'm really grasping, and there were things that Connie said in the midst of the data, is that particularly in reference to the Ukraine war and other things, I would say that beginning with COVID, we have lived with increasing levels of uncertainty. Consequently, Michael, the strategy of how the fund is managed is even more relevant in these times, because we manage with a long-term vision, and we manage a portfolio that can ride the ups and downs in the best possible way, and then rely a great deal on the incredible talent of all of those who are working at the pension fund and the risk assessments that are done on an ongoing basis. So that's my general perception. But it used to be, when I first became treasurer, that there were some very concrete, easy to develop strategies because things were a little bit more predictable. So thank God for our sophisticated ways of evaluating things. And Connie, thank you for your input. Michael, do you want to add anything before we move on?
No, I'm good.
Okay, then. Well, actually, the next item on the agenda would be the asset allocation.
Well, I do have one quick annual plan comment to make.
Okay. Sorry about that.
It's required. I'll be very quick. Our governance documents do require me to approve divisional business plans. And as we do each year, we share the plans. They're in Appendix D for your review and your input. I've already received some very useful feedback from a few of you in this group. So please feel free to contact me after you've reviewed it. We will revise the plans as appropriate to incorporate any suggestions before presenting the final annual plans to the board at its February 16th meeting. The plans are attached in Appendix D, again, and really are a continuation of the work we've already been doing for many years. I will highlight just a few new initiatives on the investment side. First, always, this has been a theme for the last couple of years. We will be adding headcount across each functional area to manage the growing assets. This has been a multi-year effort. As you know, we're one of the leanest staffs in the country compared to the size of our investment program. And the board and your direction to me has been to build a deeper bench of talent, and we're always doing that. Additionally, the future initiative, you'll see in each of the functional areas, we're going to continue to implement the 4 T's to the future initiative, which are continue to allocate capital to diverse managers, reduce the barriers, enhance our reporting, and increase and improve sourcing and pipeline of diverse managers. We're also championing the CFA's Institute's Diversity, Equity, and Inclusion Code of Conduct. As you remember, we're one of the founding signatories to that, and that is gaining a ton of steam. We're very proud of that. We'll hire staff to help oversee the future initiative. Then, of course, is the ESG initiative that I spoke to earlier. Will support the ESG committee to implement its duties and responsibilities, and will hire staff to support this newly established committee. In public markets, Mike McElroy's team will research and identify complementary active, not passive, active U.S. equity managers to potentially increase the active share of this allocation. They'll also research and identify complementary growth managers in developed international equity markets. Continue really to identify other credit opportunities. That's a 5-year-old program now, designed to pursue unique fixed income opportunities that are additive to the fund. And we'll evaluate the role of specialized equity managers in the PRIT fund, specifically concentrated equity managers or sector or country-specific managers are currently of interest. In private equity, this year Mike McGurr will be announcing a commitment goal of $2.2 billion to $3 billion to new funds and co-investments. In research, he'll be accelerating and refining our venture capital strategy. And new this year, he'll be evaluating the secondary market opportunity. That is buying and selling fund positions from others, something we really haven't utilized very often in our past. And some believe it's a good time to evaluate that. In real estate, we have some financing maturities coming due, rolling off. The team will need to figure out what to do there with a higher interest rate environment. And we'll utilize PRIM's current REIT holdings, publicly traded real estate holdings, and also our internal real estate financing facility to fund new acquisitions there. In portfolio completion strategies, hedge fund investments, Bill Lee and team will collaborate with the public markets team to explore those specialist funds and sector and country level specialist funds to see if they're a fit and what format they're a fit, whether they're a hedge fund structure or a long only structure. Real assets, where the team is spending a ton of time in the portfolio completion strategies real asset investment sleeve. Bill Lee, since inheriting the asset class in early 22, has spent a lot of time evaluating whether these investments have met our goals in terms of performance and diversification. The project will be concluded in 2023 with some recommendations. And as a reminder, we have not deployed new capital to this area in more than 3 years in other real assets under the portfolio completion strategy bucket. In risk, you'll get a benchmark recommendation today, but as you know, we're continuing to review benchmarks across the portfolio. And in research, Maria's thrust, you'll hear asset allocation today, but really to build out supplemental asset allocation research, perhaps explore the use of black Litterman overlays, and really assess the efficacy of the principal component-based asset allocation framework that we've been using for several years. So that's a brief summary. There's of the new things, new priorities. Please take a look and feel free to call me or anyone else on the staff with your comments and suggestions. Thank you.
Thank you, Michael. So, are there any questions or comments for Michael on the annual plans? Hearing none, now we will move on to the asset allocation recommendation.
Good morning, everyone.
Good morning.
The 2023 asset allocation recommendation represents no major changes to our previous recommendation. Our 2023 recommendation includes a 1% increase in the private equity range, now 13 to 19%, and subsequently a 1% decrease in global equities range, 32 to 42%. Please refer to slide 2 within Appendix E of the Investment Committee's expanded agenda for the research team's presentation on asset allocation. Phil Nelson will also be joining us from NEPC, our asset allocation consultant, and he will present the following remarks following my presentation, which are in Appendix F in the expanded agenda. Great, thank you, Tony. The Asset Allocation Research Program blends both quantitative and qualitative insights into the analysis while focusing on a dual objective. The core framework uses a probabilistic-based approach to maximize the likelihood of achieving our dual objective. As part of the Asset Allocation Research Program, we continue to be mindful of rebalancing decisions and liquidity. Thus, we maintain our comfort in the proposed recommendation. I stand before you today after a year of significant market movement, and most notably, a rising yield environment. Our Asset Allocation Research Program is comprehensive in nature. The core framework uses principal component analysis to identify areas of diversification through PRIM's actual historical experience, while we also conduct forward-looking analysis through an evaluation of capital market assumptions. This forward-looking analysis does suggest caution with regards to private equity, whereas it highlights the rising yield environment and subsequently a favorable fixed income opportunity set. However, this forward-looking analysis is very dependent on forward expectations. PRIM staff is cognizant of the rising yield environment and may allocate to fixed income opportunities as they arise, so long as they're within the approved range. For reference, slide 3 shows the approved ranges across asset classes in recent years, as well as the recommended range on the far right-hand side. On slide 4, I would like to highlight the key findings from our core asset allocation framework and systematic experiment. On the left depicts the most additive to the PRIT fund, and on the right depicts the most subtractive to the PRIT fund. As you can see, private equity remains the most additive to the PRIT fund with respect to the probability of achieving the dual objective. On slide 5, we have a deep dive into private equity here, where you can see our recommendation has remained consistent across time. I would also like to note that we do acknowledge that market conditions outside of our control may lead to the private equity actual rate temporarily outside of our range. As mentioned earlier, the liquidity risk is relatively low. Our annual redemption to pay beneficiaries is less than 2%. Through a peer assessment, PRIM's allocation is in line with similar public plans and significantly lower versus endowments. Thus, we are confident in our asset allocation recommendation with respect to private equity. On slide 6, we've included a summary takeaway of a peer assessment. The average actual PE weight is 18.1%, and the average target weight is 15%. Most plans are actually above their target weight. At PRIM, the asset allocation recommendation is centered around the ranges rather than the target weight. We are 1 out of 3 with the narrowest private equity ranges. As for endowments, their average actual weight is significantly higher than ours, with much more liquidity concerns. And so I'd like to end this presentation with our 2023 asset allocation recommendation, which includes a 1% shift in the private equity target range to 13 to 19%, and a 1% downward shift in the global equities target range to 32 to 42%. And I will open it up for any questions and comments that others may share before we can switch gears to Phil Nelson's presentation.
Maria, I have a question about the model's recommendations that you reduce international equity exposure, but that's just as it's finally beginning to add value, and when we'll see what the fundamentals of the dollar turn out to be. But I guess the question really is, are you going to act on that, or is that just something?
So that's a great question, Connie. So how I think about the asset allocation research program and the recommendation is more holistic in nature, where we have this core framework. We also have multiple other avenues of work that play into the core, play into the asset allocation recommendation. So in recent, since we've rolled out this principal component analysis, we recognize that there is some path dependency, embedded into the model. And so historically, we have been seeing the most attractive as some of these international equities. So it's really the key findings here are not anything different from in the past. And the same way, we're applying the same approach to these key findings that we have in the past, which is to acknowledge, there is the path dependency piece. Do we have a view that will continue? Do we want to implement that? And at this time, no. So we aren't, making any specific recommendations for the international equity part of the key findings here. And that's largely because of the fact that we're blending the quantitative systematic framework with qualitative insights, with understanding the macro environment, looking at capital market assumptions, having feasibility conversations with the asset class heads, and a number of other areas of work. So that is not actually representing any change in the recommendation to decrease global equity.
Thank you. Wait, and I have one more question. This is just checking, as it were, on PRIM's ability to meet liquidity needs, which I remember had been a non-issue essentially for the longest time, but our private markets holdings are larger now than a few years ago, and transactions were lower last year. I mean, is it still true? It's very, very easy for PRIM to meet liquidity obligations.
Exactly. Yes, that remains consistent as well. We pay out to our beneficiaries less than 2% of the PRIT fund, and currently our actual weight to private equity is 17.7%. So even with this small change to move up to the range, the top end of the range potentially at 19%, there is no liquidity concern. And we see this especially with our peers. There's some of our peers in the U.S. pension plan space have larger ranges and even, potentially higher target points or actual exposure. But most notably, our peers in comparison with, in the endowment space. So in the endowment space, you can see an average, actual weight of like 36% for just private equity in general. And their payouts tend to be significantly higher than ours.
Right.
And also, the final thing is that we have consistent commitments coming in as well. So that's also a really key component to PRIM's portfolio.
It's a good question, Connie, and it's actually front of mind for us is the proportion of the liquid assets in the fund. It will be a project that we're going to explore in 2023 to see at what point might liquidity be an issue, but in this year it won't be. I mean, as I mentioned, it was less than $1 billion in the last 12 months of redemptions to pay benefits, pension benefits. So right now it's not a problem, but I think it's instructive to think about when it might become a problem. So we'll be looking at that and we can report back to you. I thought this might be a good opportunity for Jay.
Mike, can I just ask one more question?
Yes, go ahead.
Maria, we spoke about briefly. I would have expected a little bit more of a change in fixed income given the dramatic move of the markets and the changes in yields. Can you just comment about that a little bit?
Yeah, that's another great question. And so when we look at, I don't know if, Tony, you can pull up the slides again, but essentially the biggest takeaway for core fixed income and value-added fixed income is that, our ranges right now for core fixed income is 12 to 18%, and the actual weight exposure is 13.8% for core. So we're really, on the lower end of that range as well. And for value-added fixed income, we're at 5 to 11%, and our actual rate is 7%. And so the way that we think about asset allocation in terms of changing the ranges is, there's multiple layers to the process, and some of which is, do we need to be shifting up to give them room to move and see opportunities as they arise? And at this time, we are cognizant of this rising yield environment. As I've noted, the PRIM staff is aware of it, and we are constantly looking at opportunities, and they may continue to allocate to those opportunities in more detail, just as long as they are within the ranges. We feel like these are really healthy ranges to continue to take advantage of this environment.
Okay, thanks.
Yeah, and I thought it might be helpful for the committee to hear Jay's view on the risk profile of the fund in terms of this asset allocation recommendation. Jay, maybe a couple minutes.
Okay, so so I'll go in front of Bill. We'll put Phil to.
Yes, why don't you just talk about how we look at risk in terms of the three buckets?
Okay, sure. I'll go through the things and a few observations related to the PRIT fund. And Tony, if you can pull up the kind of total PRIT fund risk slide and go to page 3. Also, we look at total PRIT fund risk through the lens of the building blocks of risk: equity risk, interest rate risk, and credit risk mainly, and then some private factors also. But really, those three building blocks: equity risk, interest rate risk, and credit risk. Equity risk contributes about 74% of the total PRIT fund risk. Interest rate risk 1.3%, credit 2.7%, and that's due to our growth objective of the fund. On slide 4, you can see the global equity and private equity account for about 56% of the market value, but about 80% of the total risk. And the key thing, when we look at the PRIT fund, we think in terms of
that motherfucker.
Welcome to enter your meeting ID followed by pound. Welcome to Zoom. Enter your meeting ID followed by pound. Enter your participant ID followed by pound. Otherwise, just press pound to continue. Please enter the meeting password followed by pound. You have joined the meeting as an attendee and will be muted throughout the meeting.
Distributions or realizations are down with the weak IPO market. And the result, as Michael Trotsky mentioned, is the plan sponsors are not only overly allocated or over-allocated to private equity, but a large percentage are out of the range. So we've been focusing on not only the weight of private equity, but the cash flow or liquidity profile. And as mentioned, the goal has been and we have benefited from diversification by vintage year. So number one, being there to participate when equity markets are weak has been really important to PRIM success. And then also, as Maria mentioned, vintage year diversification provides a more consistent liquidity profile or cash flow profile over time. If you ramp up private equity all at once, that money's not coming back for 7, 10 years. Whereas if you're consistently investing, that improves your liquidity profile. And I point out in this kind of difficult environment where some of these variables have been changing, Melissa Fiore and Michael McGurr have really done an outstanding job of keeping the commitment plan modeling plans and in where we want it to be, whereas many other plans have struggled. Now, in terms of private equity, some elements the risk and the PE team are monitoring or studying right now is, number one, we're thinking about widening the allocation range. And this, we're just looking at this right now. We've gone from 10% private equity weight to 18%. The range that Maria presented is still 6%, and many of our peers use a 10% range. So that's something we're looking at right now. The other element is how we manage risk if we go outside of the range, as Michael was talking about. And we look at that combined equity risk of global equity and private equity. And all else being equal, we would look to cut global equity exposure if private equity did go outside of the range. And we would continue to manage that combined equity risk. Again, we think in terms of equity risk, interest rate risk, and credit risk building blocks. And then lastly, to Connie, which Maria answered, liquidity and cash flow, we're looking at that and continuing to monitor that. Although the PRIT fund, as Maria mentioned, has ample liquidity and low liquidity demands, but that is something we're mentioning.
Excellent.
And so that's on the private equity. Mention how it influences the benchmark analysis, I guess maybe when after Phil. So we
that sounds good. That's perfect, Jay. Thank you. It provides some context on the range.
Great. Well, I'll keep it brief just to keep things moving along. So everybody, I'm Phil Nelson from NEPC. We want to briefly pull up Appendix F and go to the second page to highlight kind of just an overview of the plan. And I'd say kind of overall, no kind of major recommendations that we had in terms of changes, working with Maria and her team, and kind of very supportive of kind of incrementally increasing private markets exposure. I think first and foremost, being able to be a liquidity provider in this type of market environment, certainly pays dividends over the long term. So a couple of things I'd highlight is just in terms of the expected return. Interest rates have risen, quite significantly relative to last year, and that brings with it a higher expected return, both over our 10-year expectation and 30-year expectation. So now we're kind of in line and above, PRIT's long-term EROA. And if we go to the next page here, we look at kind of an asset class level in terms of what we see in terms of the, profile. I believe it's page 3 of Appendix F. You can see some of the changes relative to last year in terms of our capital market assumptions. I think, probably highlight, first and foremost, just the changes in the fixed income space. So some of the questions earlier, how we've been thinking about, fixed income allocations is something we've been, chatting with Maria and her team, and, they're very much, kind of aware and on top of the market conditions. I think one of the uncertainties that we have, and you heard this from Connie, is how sustainable is the current market environment? If we have an environment where, let's say, the 10-year yield can stay close to 4, above 4, and that's the new, call it terminal value, then thinking about kind of incremental increases in investment-grade fixed income, or kind of more traditional fixed income, or even, the value-add category, likely will be beneficial from a risk-return standpoint. I think in this current market environment, it's often prudent to be kind of slow and steady in terms of making changes. And I think in this case, having the flexibility with liquidity profile, be able to put some incremental commitments into private markets when maybe others are struggling, we think is a good approach. So I'll pause there, and later in the deck we have some slides in the market outlook, but I think Connie covered much of it with her comments, and I would just say it really is interesting, confounding, difficult kind of market outlook. And I think, the biggest piece that, we're focused on is essentially what's the trajectory of wage changes in the U.S. and how does the Fed make policy changes relative to that. And I think to some degree, we prepared ourselves for, Fed funds to be well above 4% for a couple of years. And that likely is a more challenging market environment seen relative to the last decade. So I'll pause there and see if there's any questions on our assumptions or anything else.
Okay. Otherwise, we can, thank you, Phil. We could probably go into the vote for the asset allocation recommendation.
Okay, then, if there are no further questions, I would seek a motion that the investment committee make a recommendation to the PRIM board to approve the 2023 asset allocation recommendation as described in the expanded agenda, and further to authorize the executive director to take all actions necessary to effectuate this vote. Is there a motion?
Yes.
Is there a second?
Yes.
Second.
Okay, then. I will proceed. Any other further comments or questions? Otherwise, I will proceed with the vote. Leroy? Michael?
Yes.
Connie?
Yes.
Ellen?
Yes.
Phil P?
Yeah.
Phil R?
Yes.
Glenn?
Yes.
And Tim?
Yes.
Myself, yes, the motion carries. Thank you, everyone. All right, next item.
I believe Shannon will be presenting this.
Yeah. I just wanted to give a brief thing on, so back to the benchmark part.
Oh.
This framework on the benchmark, so Shannon will present on the hedge fund benchmark, but this equity risk, interest rate risk, and credit risk framework that we talked about influences not only how we're thinking about the private equity management, but the views on benchmarking, and specifically with respect to risk exposures, expected returns, and thinking about the role. So this benchmark we're trying to capture is reflect the risks in terms of equity, interest rate risk, and credit. And by reflecting these risks, the benchmark answers the question, what return will be earned in the public market? Are we better off than in the public market? And then lastly, hopefully these things, the benchmark framed in those terms helps us better think about the role of the asset class in the plan. So again, that credit, interest rate, and equity framework. So I'll turn it over to Shannon to go through the benchmark recommendation for hedge funds.
Good morning, Treasurer. Good morning, committee members. Tony, if you could turn to our presentation. Thank you. In Appendix B. As most of you know, Jay and I have been working on a benchmark project along with Barris, and also input from each of the asset class teams. In this case today, the PCS team. We hired Barris as our benchmark consultant in January 2021. One of the initial objectives for Barris was to help us do a comprehensive review of all the benchmarks we use at PRIM. To date, we have reviewed and recommended changes for PRIM's private equity, global equity, core fixed income, value-added fixed income, private debt, and real estate. Today's recommendation is for hedge funds. There are two benchmark recommendations for the hedge fund subcomponents, which are both voting items. The first is to introduce a new core or primary strategic benchmark for stable value and directional hedge funds and the PAMCO fund of funds. The second is to recategorize the current core benchmark for stable value and directional hedge funds to be the implementation or secondary benchmark. Just to review, our philosophy for choosing a benchmark is 1, it should be representative of the opportunity set. 2, it should be reflective of the return and risk of the asset class or sub-asset class. Some other important features which are nice to have are the benchmark should be investable and known before the fact, and it should be measurable, transparent, and unambiguous. In the case of hedge funds, it was difficult to achieve all the desired benchmark qualities
given the heterogeneity of the underlying manager strategies. Instead, we focus on the opportunity cost of each hedge fund sub-asset class as a whole and their return characteristics when selecting a strategic benchmark. In working with various on hedge funds, they shared their belief that hedge fund benchmarks should provide a link between expectations and success. Tony, if you could turn to page 3. PRIM's approach to benchmarking private assets has been to use a strategic or public plus benchmark as the core primary benchmark and a peer benchmark as the implementation or secondary benchmark. When using a strategic or public plus benchmark, it's important to focus on longer-term results such as 3 to 5 years to gauge private asset success. In the short term, there can be mismatches between the public markets, which are priced daily, versus less frequent and often lagged valuations for private assets. This is particularly important to remember during volatile market environments such as now. Strategic or primary benchmarks are used to measure the efficacy of the allocation decision. In other words, would we have been better off in the public markets rather than the private assets? For example, for private equity, we use a blended Russell 3000 Europe IMI benchmark to gauge how our private equity investments are doing versus that public markets alternative. The key question when choosing a strategic benchmark is, what public market exposure are you getting with a particular investment in terms of equity, credit, and interest rates? The implementation or secondary benchmark is a measure of manager selection. It helps us evaluate how PRIM's private assets have performed versus their asset class peers. In other words, are we implementing the strategy well and picking good managers? Tony, could you turn to page 4? For background, the hedge fund program is part of a strategic allocation within the portfolio completion strategies sleeve, or PCS. Within the hedge fund program, we invest in direct hedge funds and fund of funds. Direct hedge funds are split into 2 subcomponents, stable value and directional hedge funds. The 2 groupings were created in early 2020 as part of PRIM's annual asset allocation to separate long-biased hedge funds from those with near-zero equity exposure. In the fund of funds group, PAMCO is the one remaining legacy fund of funds manager. PAMCO targets an absolute return while maintaining reasonably low volatility. The manager invests in multiple hedge fund sub-strategies and has a focus on emerging managers. Tony, please turn to page 5. Stable value funds as a group have near-zero exposure to equity risk with a beta to the S&P that is very close to 0. These investments also have a low exposure to credit and interest rate risk on average. The PAMCO fund of funds portfolio has a very similar risk profile. Due to this low market exposure, the public market or opportunity cost of this group of investments can be proxied by cash. Cash benchmarks, while not perfect, are often used as benchmarks for absolute return strategies. The PCS team conducted a research project on hedge fund practices among pension plans and endowments. Their research included a third-party benchmark survey of several asset allocators. Of the survey respondents, 70% used cash or cash plus benchmarks to evaluate hedge funds. While cash benchmarks are often used, it is important to note the volatility mismatch. Cash volatility is 0, but the volatility of PRIM's hedge funds is greater than 0. To compensate for this higher volatility and higher return expectation, a premium needs to be added to the cash benchmark return. We are recommending a 200 basis point premium given the volatility of PRIM's stable value and PAMCO portfolios. This is consistent with the range of premiums for cash plus benchmarks in the third-party survey. It is also the amount recommended by Vera, our benchmark consultant, based on their return analysis. We are recommending the same benchmark for both stable value and PAMCO. Directional hedge funds tend to be long biased and have systematic exposure to equity. The typical beta to the equity market for these managers ranges from 0.4 to 0.6. Here, the public market exposure can be proxied by 50% MSCI equity plus 50% SOFR. We used 50% equity exposure for the benchmark to reflect an equity beta of 0.5 for the group.
We also chose MSCI AXI over US only benchmark as the geographical mix of the underlying loans is roughly 60% US, 40% the rest of the world, which is similar to the AXI index. The liquidity and volatility of these directional hedge fund assets are in line with the public markets benchmark, so no liquidity or volatility premium needs to be applied. I'll turn it over to all of you for any questions before going to the voting items.
Are there any questions? No questions for Shannon? All right then.
Do you want to read the voting items, or should I read them? 7.
I'm sorry, you're cutting out. Did you say, I had thought you said you were turning it over to Bill Liu?
No, for the voting items, are we going to do that now?
Oh, I will. Okay, that's what I wanted to find out. I thought I was having difficulty hearing you, so I was saying, not thinking you were saying you were turning it over to, because your microphone's cutting in and out a little. All right, then. I am going to, we're moving on to the voting item, which is the hedge fund benchmarking recommendation. I will seek a motion and a second, and then we'll have the explanation. Correct, Shannon?
Yes.
Okay, thank you. I seek a motion that the investment committee make a recommendation to the PRIM board to approve the hedge fund benchmark recommendation as described in the expanded agenda, and further to authorize the executive director to take all actions necessary to effectuate this vote. Is there a motion? Anyone? Second?
Second.
Okay, thank you. Is there any further explanation necessary for this?
I don't think so.
Sorry?
I don't think so.
Okay. In that case, are there any questions or comments from members of the board? Hearing none, I will proceed with a roll call vote. Leroy?
Yes.
Michael?
Yes.
Constance?
Yes.
Ruth Ellen?
Yes.
Philip P?
Yes.
Philip R?
Yes.
Glenn?
Yes.
Timothy?
Yes.
Deborah is a yes. Thank you.
Thank you.
I think Matt's up next, right?
Believe so.
Okay then.
Would you like to read the motion first and Matt can chime in, or?
Yes.
Yeah, it is a voting item.
Okay. I would seek a motion that the investment committee make a recommendation to the PRIM board to approve the issuance of a request for proposals for investment performance reporting services as described in the expanded agenda, and further to authorize the executive director to take all actions necessary to effectuate this vote. Is there a motion?
So moved.
Is there a second?
Second.
Okay, go ahead, Matt.
Thank you. And I'll be brief. We are seeking approval to issue a request for proposals for investment performance reporting services. As this is a new service for PRIM, currently don't have a true provider for this. There's two main goals that we're looking to achieve. First, we're looking to find a vendor that can visually enhance the monthly, quarterly reporting, which we provide to you, the committees, the board, our participants, our clients, and additionally, what we use internally. Secondly, we're looking to find a vendor that's going to be able to bring efficiencies and automate our performance reporting process. You know, there are a lot of hours that are spent putting together the slide decks in front of you today, and that's done by, you know, several individuals across the organization. And again, we do a great job, but I think bringing some automation and efficiency to that will allow us to do more analytical components into the report rather than, you know, the necessary processing for building them. So those are our two main goals that we're looking to achieve with this. There are other ancillary benefits that I see that we can gather from having a potential solution. We've had some brief discussions with providers in this space and look forward to this procurement
Are there any questions for Matt?
Matt, I mean, this sounds really cost effective, but what is the anticipated cost?
So it ranges. Again, it depends on the type of provider that we're looking to do. A lot of them have some data elements with them in sort of data aggregation. But I'm thinking around $150,000, $200,000 a year.
Connie? Any further questions on that?
No. I mean, this sounds like it'll really help.
Any other questions from members of the investment committee? Hearing none, we will proceed with a roll call vote. Okay then, Leroy?
Yes.
Michael?
Yes.
Connie?
Yes.
Ruth Ellen?
Yes.
Bill?
Yes.
Bill?
Yes.
Glenn?
Yes.
Tim?
Yes.
Myself, yes. The motion carries.
Thank you, everybody.
Thank you. Now, next.
Thank you. I think Mike McElroy.
Yep, public market. And there is a voting item, but I'm assuming, Mike, that you're going to go through some other things before we get to that. Is that correct?
Correct. I'll just provide a summary of the quarter and the year and then pass it over to my colleague, Andre Abahala, for the voting item.
Thank you.
So, good morning, everyone. This is Michael McElroy. As I mentioned, I'll cover hopefully briefly because we've talked a lot about the markets already, Q4 and then the full year, and how we performed in this environment. I think just to reiterate, to begin with, we certainly welcomed the recovery we saw in the fourth quarter, both in the public equity and bond markets. We had seen the 3 consecutive quarters of negative returns in these normally uncorrelated asset classes. So that was certainly refreshing. In the quarter, as we've highlighted, global equity returns ranged from about up 7% in the U.S. markets to up 15% in the non-U.S. markets. We saw value outperforming growth in all geographies. And for the year, equities were down a little less than 20%, fairly broad-based across geography and sector, really with the energy sector the only meaningful exception for the year. And just as in the fourth quarter, value was the highest performing style, and this may be a trend that continues into at least the first half of this year. Bonds, a little bit more mixed, shorter duration bonds in the value-added areas like high yield and emerging markets debt were up between 2 to 7% in the quarter. Longer duration bonds, those 20-year plus duration, lost value as the long-term interest rates declining through most of the quarter ended slightly higher at the end of the fourth quarter, and so that impacted the value there. For the year, the core fixed income, kind of depending on duration, was down between 12 to 40%. Value-added fixed income, which is less sensitive to these interest rate movements, did help provide some downside cushion for us, and those strategies declined only about 7% for the year. The U.S. and many of the developed markets yield curves remain inverted. The Fed funds rate increased over the quarter and certainly for the year. But expectations from this point are for smaller and more measured increases, and then, as Connie mentioned, potentially some decreases as we get toward the end of 2023. So within this backdrop, the results were within our expectations for public markets. All regions of our global equity portfolio outperformed in the fourth quarter. Strongest results were actually in the developed international area, which had been challenging for us earlier in 2022. Similarly for the year, U.S. and emerging markets managers outperformed in aggregate for us, but our developed international exposure, and particularly the growth style, did drag down our overall results in the developed international. Within fixed income, core and value added slightly underperformed in the quarter, and for the year, core fixed income was in line, while value added underperformed due to credit conditions weakening throughout the year. It's also worth noting, and Michael Trotsky mentioned this, that the fourth quarter marked 5 years since we started making allocations to what we call our other credit opportunities bucket, where we're investing in credit strategies that complement our high yield bank loans or emerging markets debt exposures. So though the fourth quarter was challenging in this area, over the 5-year experience so far, it's been a source of very uncorrelated returns and strong absolute and relative performance. It's an area we continue to be excited about, particularly as these market dislocations and diminished liquidity have made these credit strategies, which have stronger covenants, better collateral, and more conservative valuations, relatively more attractive than opportunities we see in other areas. As we've talked about with the economy, there continue to be mixed signals on really the two most prominent topics impacting the market, the inflation and the potential for recession. Inflation does seem to be moderating somewhat across most geographies. Money supply being reduced, savings levels are down, supply chain disruptions less frequent. On the other side of the ledger, labor shortages and wage costs continue to be sticky. Deglobalization may lengthen this inflationary horizon a bit. With respect to the recession, it could be upon us, as we've talked about with the inverted yield curve, weak and falling leading economic indicators and manufacturing surveys signaling slowdown. But on the flip side, the labor market is robust and the credit conditions remain fairly benign here. So as we noted last quarter, balance sheets had been fortified by investors and companies prior to the rate increases we saw last year, which really should forestall any meaningful uptick in defaults where we'd experience some level of recession. So net-net, it's a murky picture, one that we discuss with all our managers to get their views on, as well as how they're positioning for it. So in addition to these two important topics, our managers have highlighted several other positives. Supply chain issues, which had been impactful earlier in 2022, have improved a lot because companies have diversified these supply chains, and India has been a particularly beneficiary of this, given the manufacturing and transportation improvements that they've been making in their economy over the last decade. Companies are still reporting decent fundamentals, and this is a finding that we're able to corroborate within PRIM across the different asset class teams. So this is something that our managers continue to monitor closely for signs of slowdown. China reopening and the boost that this could provide to global growth is certainly a positive compared to last quarter and earlier in 2022. On the risk side, risks that our managers are focused on span the ongoing issues that we've talked about, escalation of the Russia-Ukraine war, some of its effects on food and other kind of supplies to the world, to new concerns like the potential U.S. government slowdown or shutdown, kind of relating to these debt ceiling negotiations that are upcoming. Global housing prices slowing down potential and any knock-on effects to the consumers is something we're also closely watching. So in closing, market conditions have been and remain choppy. We've built the public markets portfolio to weather this turbulence. As we've said before, high volatility should be a good environment for active managers to add value. Managing all these changing risks simultaneously can and has at times proved challenging. We're encouraged by the diversification that we've built into the PRIT fund and that our managers have provided. We saw a nice recovery in Q4, and both the relative and absolute returns remain very strong over the long term in both equities and fixed income. The aggregate risk of the overall equity and fixed income portfolios remains low, as I think Jay highlighted, and risk factors are balanced across these managers. So with that summary, I'm happy to take any questions that me on the committee have.
I'm following up on a question that Mike Gavin asked of Maria earlier. Can you remind us of what the investment process is for there to be a proactive change, not a market-driven change, a proactive change of what the equity exposure is within the range or what the fixed income exposure is within the range?
Yeah, so we source our ideas bottom up. We're looking for managers that have idiosyncratic skill when we hire active managers. Around the allocation, as Maria mentioned, we have latitude. We have within these ranges. And We've always said we don't have a crystal ball. You know, the historical returns of fixed income versus equities on a risk-adjusted basis have kind of put us to where we are within these ranges. On a forward-looking basis now, though, and Maria highlighted this, some of our forward-looking modeling indicates that risk-adjusted forward returns could look a little more attractive, potentially in fixed income than they have historically. So because we have latitude within this range, this would be a decision that we would make in conjunction with the risk team and the research team, and certainly, within PRIM before making that ultimate decision. But we have the latitude to do it. So it's both quantitatively derived from some forward analytics we have. Mike Trotsky mentioned Black Litterman, as well as a judgmental decision staying within the risk envelope that we have to work with. Does that help, Bill?
Yes, thanks. I guess when is, if you know, when is the last time that the team did make a proactive allocation change within the range in either equities or fixed income?
I don't know. We haven't made any kind of active movements across equities to fixed income in the last year and a half that I've been here.
On the margin, you're adding diversifiers like value managers versus growth managers has been trying to balance out the risk profile. So we continue to do that, and that is an active decision. So balancing the risk profile leads to those decisions. And I would say, our Chuck and Andre are constantly evaluating the landscape of managers and opportunities out there. And it seems to me that good opportunities bubble up to the top and cause us to prioritize them. And right now, as Mike McElroy just said, what's bubbling to the top is really other credit opportunities.
And one other point, just in our kind of monthly process of, operational cash flow needs and evaluating our portfolio, we are forced to rebalance or to transact, and we do incrementally change based on desires to either increase our fixed income allocation or our equity allocation, or even underlying allocations within the global equity portfolio or underlying the fixed income portfolio. So it is an incremental move. We are not, making large tactical decisions, as we've all said many times, but we do incrementally improve the portfolio, as part of our monthly process.
Any other questions?
Any other questions at all? Okay, then. And who will be presenting on the voting part of the item?
Andre.
Hello, Treasurer. I think Tony, Renee, I think we have something procedurally.
I'm going to actually request that we do the motion and a second. I don't know what else might be happening procedurally.
I think there was concern about the missing motion, but I think that concern has been resolved.
Yes,
Sorry again, and thank you for that.
I have it right here.
Thank you, I appreciate it.
I even printed it, so I wouldn't. All right, you ready? Okay. I seek a motion that the investment committee make a recommendation to the PRIM board to approve the selection of Makita Investment Group to provide public markets advisory services as described in the expanded agenda, and further to authorize the executive director to take all actions necessary to effectuate this vote. Is there a motion?
I will recuse myself at this point.
Okay. Is there a motion?
So moved.
Is there a second? Okay. Michael.
Yes.
Oh, no, we're not taking the vote. Sorry. Leroy threw me off. Go ahead, Andre.
Thank you, Treasurer Goldberg, and good morning, everyone. Great to see you all. I am Andre Bahala, Investment Officer on the Public Markets team, and I will be presenting a recommendation for the Public Markets Advisory Services RFP. Just to go over the timeline, PRIM issued the RFP on October 31st, 2022. By the deadline of December 2nd, we've received 7 proposals. Respondents included Aon, Callan, Makita, NEPC, RBK, Veris, and Wilshire. The evaluation committee consisted of Michael McElroy, Chuck LaPasta, David Gertz, Jay Liu, Shannon Erickson, Tony Falzone, Matt Leposki, Francesco Danielle, and myself. All of the responses were thoroughly reviewed, and finalists were selected based on the criteria detailed in the RFP. 5 finalists were selected for in-depth interviews to better understand their approach, experience, and qualifications. These interviews were held in person and virtually at PRIM offices. And after careful consideration, the team unanimously recommends the selection of Makita Investment Group. Makita is based in Westwood, Massachusetts, and have been solely focused on investment advisory services since its inception in 1974. The firm is 100% employee-owned by more than 70 senior professionals who are all active employees. Makita is ranked among the top 10 largest investment consulting firms worldwide, consulting on over $1.6 trillion in assets for 245 clients, including over 90 public clients. The proposed primary advisor to our account, Andy Sang, serves as Makita's Director of Public Markets Manager Research. She has over 20 years of industry experience, including 17 years focused on research and investment management. The account is further supported by Josh Bro and Haley Tran, who are the co-heads of equities at Makita, Stephen McClellan, a managing principal consultant, and Mark McCune, who is their head of fixed income. We are particularly impressed with this group of individuals as they average 20 years of industry experience, oversee major asset classes at Makita, and work with other large public pension plan clients like PRIM. Given the size and scale of the team, Makita's advisory services can be customized to complement our internal capabilities and address specific needs. Their team will integrate into our processes and can serve as an extension of staff if needed. We expect them to assist on a wide range of areas, so that includes strategic planning, portfolio construction, investment due diligence, manager selection, ongoing monitoring, ad hoc research, and reporting. PRIM does have an existing relationship with Makita. The firm currently serves as a member of PRIM's pool of real estate and timberland advisors. And in that role, they've collaborated on past credit opportunities with the public markets team. Lastly, in terms of cost, PRIM has negotiated an annual fee that was competitive with the other proposals received. Thank you for your attention and consideration. I'm happy to answer any questions you may have.
Anyone have any questions for Andre?
Well, I do. I'm wondering, it would be great to have Makita as our advisor, but we want Leroy also. I mean, are there procedural items we should be thinking about and how to make this work?
Yeah, he just can't vote on hiring Makita, but he'll be able to be an active participant in any recommendations that come through Makita subsequent to this. So he's just not allowed to vote on hiring Makita.
I see. But Leroy can be involved in the work they do internally.
Well, he actually won't be on the account team, which is probably best practice. But they have a deep bench, lots of great employees. Our team, we're very, very happy with the team they've assigned to us. But his role will be undiminished on the investment committee with respect to evaluating opportunities going forward, if that's your question.
Okay.
Are there any other questions? Hearing none, we will proceed with the vote. Michael?
Yes.
Connie?
Could I abstain from this one? I just need to think about it a little further than I have.
Sure. Unless you want me to come back to you and take the vote very slowly.
No, thank you. Longer than this. I think it's going to pass. I think this is not going to make a difference.
Okay, Ruth Ellen. Yes. Phil.
Yes.
Phil. Did we lose Phil Rotner? I see his name's still there. I'm gonna Glenn.
Yes.
Kim.
Yes.
Myself, yes. I'm coming back to Phil Rotner. Do we need, with Connie abstaining and Leroy abstaining, do we need Phil's vote? Renee?
I'm sorry, I need to count how many votes we have.
Connie, we may need you to think fast.
Maybe, and I'll support it if need be.
We need her vote. Okay. Or we need an additional vote. Let's see, we have 1, 2, 3.
I think we have enough.
I have 6. Do you have 6, Renee?
We have the treasurer.
I don't think I voted yet.
Oh,
But yes, you do have me.
okay.
And we have Mike Evans. Don't we have 7?
1, 2, 3, 4. No, we don't.
Nope.
I count 6.
6. We have 6.
Phil, are you there? Phil Rotner?
I'll support it.
No, we actually have 7 with me. Tim Glenn, Phil P, Ruth Ellen, Michael Evans, myself. How many?
And Glenn.
And Glenn was 6. 1, 2, 3, 4, 5, 6. Yeah, we do need the 7. Oh, Connie.
Yeah, that's fine. I'll support this.
Okay, thank you. And I'm saying again, I'm voting yes, and so the motion carries. That was a first in over 8 years. A first. Yeah. Interesting. And by the way, that is the end of the open session. I have to start reading a closing.
Wait, we have 2 more items. Portfolio completion strategies.
Oh my God.
Equity.
We do. Sorry about that. It was the last voting item in the open session.
So Bill Lee first, and then Mike McGurr.
You got me.
Madam Chair, this is Tim Vale. I'm going to have to cut off now. Thank you.
Okay, then. Thank you, Tim. All right. Go ahead, Bill.
Thank you, Chair. And good morning, everyone. Still good morning. Thanks to multiple conversations with Theo Parameter, and thanks to the benchmark exercise with Jay Lu and Shannon Erickson, PRIM hedge funds' strategic role has been further metrified, and that would give the team more clear-headedness, making investments, and guide us to communicate results more effectively. Now, performance. In Q4 2022, PRIM hedge funds, which is roughly 90% of PCS, increased by 1.5%. The remainder 10% of PCS, real asset, was marked down by 5.9%. Since inheriting the coverage of real asset in early 2022, my team has spent tremendous time rationalizing this pocket with help from real estate, legal, and risk teams. We look to finish the review of real asset within 2023. And netting between hedge fund and real asset PCS in total increased 77 basis points in Q4. For the full calendar year, PRIM hedge fund was slightly down by 1.9%, with an equity beta of nearly 0.1. That provided ample risk buffer to the total PRIT fund in a year when the 60/40 market mix declined by over 16%. View the diversification benefit from another angle. If you take the return difference of the hedge fund over the 60/40 market portfolio, that's 14%, and then multiply by hedge funds 8% of weighting. So 14% times 8%, that equates to a 1.2% lower drawdown at the PRIT fund level. In other words, PRIT fund would have been 1.2% worse off without hedge funds. Over a trailing 3-year and a 5-year time frame, the hedge fund programs realized equity beta and the bond beta remained low, exhibiting strong diversifying benefits in a tumultuous environment. Notably, on a beta-adjusted basis, PRIM hedge fund also outperformed both equities and bonds. If I may direct your attention from past performance to 2023 and forward, I would like to highlight the team's observations that signal an exciting year for the hedge fund allocation. Stable value funds, the biggest hedge fund sleeve that delivered a positive 2.3% last year, is largely comprised of relative value and low beta event-driven investment mandates. Those mandates make money by smartly capturing spreads. And the spreads, be it credit spreads or mispricing arbitrage, have been reasonably wide so that managers across the board are expecting high single-digit returns with a lower risk. Directional funds, which are stock pickers and credit pickers that are absolute return-oriented, see tremendous valuation support in selected papers. This year, we should anticipate ample alpha potential from directional managers' security selection. In summary, we have obtained a higher confidence that PRIM hedge fund is in a very good position to perform this calendar year. And with that, I'm happy to open the floor for questions.
Are there questions for Bill? Not hearing any at this time. Bill, do you have anything further to add?
No, that's my comment so far. We really remain confident, if not more confident, about this portfolio.
Okay, great. Thank you, Bill.
Just one question. I'm curious, by year end, will hedge funds comprise, or how large a bulk of your total portfolio will be hedge funds by year end?
So by calendar year end 2022, hedge funds in total accounted for roughly 8% of the total PRIT fund. So that's within the allocation range.
Bill, I meant of your own. It sounds like some of the other real assets will not be in the portfolio by year end.
Oh, I see. So hedge funds in total, that's 90% of PCS. And the PCS is roughly 9% of total PRIT. So in terms of real asset is 10% of PCS, or less than 1% of the total PRIT fund. Does that answer your question, Connie?
Yeah, it does. It sounds like you were going to unwind some of that small sleeve.
We're very actively
we can't really
our plans. Yeah, we're at a stage that we cannot talk until hopefully by May or June.
Thank you. With that, we will move on to private equity. Mike?
Thank you. Good morning, Madam Treasurer, members of the Investment Committee. I'm Michael McGurk, Director of Private Equity. I'm going to talk about the market and some performance. As we've discussed, 2022 was a tough year for private equity. A lot of challenges, and those challenges remain into 23. 2022 global M&A was down almost 40% compared to 21. The reduction in activity got more pronounced as the year went on, with Q4 seeing a drop of over 56%. U.S. M&A volume also fell by 43% year over year, and that volume has dropped as sellers adjust to the fact that they're no longer receiving 2021 pricing. And buyers are also recognizing the reality that they're not able to receive the financing of yesterday either. In the U.S., PE deal-making volume declined 20% for the calendar year. Number of transactions was only down 2%, as larger deals were fewer and further between. Like M&A trends, that activity really slowed down over the course of the year. There still is, however, considerable amounts of dry powder, over $1 trillion globally. However, that dry powder actually shrank by 11% in 2022. And that's the first time we've seen industry-wide dry powder shrink since 2008. Exit markets were difficult in 22. Those challenges largely remain as we enter 23. The U.S. IPOs had a terrible year. Only 74 companies listed in the U.S. Proceeds were down 95% compared to 21, and the overall number of IPOs were down 88%, resulting in the fewest number of IPOs since 2009. Earlier this year, we discussed what we thought would be a deep correction in venture and growth. We continue to see those markets correct as we enter 23. Our view is similar today, and if anything, we think this correction may be longer than we originally thought. As the market slows and adjusts, the silver lining, as Michael Trotsky had mentioned, is that things are getting less expensive. You know, an example that, you know, our managers like to talk about is unprofitable tech companies have probably seen the most dramatic re-rating in the public markets. Unprofitable software companies traded at 17 times forward revenue at the end of 21. And today they're trading at just over 3 times forward revenue. That is a massive decline, an 80% plus decline. However, the aggregate headline U.S. PE valuations remain somewhat elevated. But we know this market is changing rapidly. We know the info is lagged, and we know that the average does not tell the whole story. Financing got materially more expensive for private equity buyers over the course of 22. As the cost of capital increased throughout 22, we saw bank lending effectively shut down for new LBOs. Leveraged loan volume for the U.S. LBO market was just $13 billion. That's down from $146 billion, an 80% decline. Leverage is about 1 to 1.5 turns lower than 6 to 12 months ago. Spreads are wider, between 100 and 150 bips. The docs are tighter. The approval process is longer. All-in cost of debt is between 11 and 12%, and that's about double from where it was about 12 months ago. Fundraising, as a result, we're seeing a slowdown. The debt markets are slowed down. The PE activity is slowed down. This is slowing the investment pace of the PE managers, and it's finally resulting in a slowdown in fundraising. PitchBook has called, I think accurately called, this the most crowded fundraising market in history. Many investors are going to find themselves, or are finding themselves, over-allocated to private equity to start 23. Combined with the slowdown in distributions and a reversal in performance, investors are going to be forced to make really tough choices in 23 and beyond. Turning to performance, private equity was down 51 basis points gross for the quarter, or 80 bips net. That decline was less than the decline of the public markets in Q3 of 2022, with the Russell for the quarter ending 9/30 down 4.5%, and the MSCI Europe, IMI down almost 11%. Our trailing 1 year for private equity was a negative 4.75% gross, or 5.75 net. And again, that compares favorably, less of a decline compared to the public markets. The Russell 3 over that similar 1 year time period down 17.6%, and the MSCI Europe down over 26%. Our 3-year, 5, and our 10-year numbers remain strong at 26, 23, and 21%, respectively. Those are all gross figures. And some additional color for the quarter and the 1 year for private equity performance. Venture capital and growth continue to give back some of the gains from 2020 and 2021. For the quarter, growth equity was about flat, but down about 16% for the trailing 1 year. Venture, similar story, down 2% for the quarter, but also down 17% for the trailing 1 year. Buyouts, as we've discussed, have been a bit more resilient. SMID was down 2% for the quarter and is actually up 3% on the trailing 1 year basis. And our larger buyouts have not performed as well as SMID, down 4% for the quarter and down about 7% for the trailing 1 year. On a sector basis, you're seeing similar trends to what Mike McElroy discussed in the public markets. Energy, industrials, and materials sort of leading the way, technology lagging, and our value and our deep value managers continue to have strong year as well. Our growth and venture managers are struggling. Cash flows. We have seen 1 full year of negative cash flows with contributions outpacing distributions. You'll see this on the open materials on page 9. What is, hidden in these numbers is the scaling of PRIM's co-investment portfolio and its relative immaturity compared to the maturity of the rest of the portfolio. Meaning, we've been growing, doing more co-investing alongside our managers to a greater degree than we have been growing the rest of the PE program. Now, that being said, our team will have an increased focus on distributions in the coming quarters, as that's a key performance indicator as well as an important measure of portfolio health and quality. As we've discussed, PE assets are about flat, 17.7% of PRIT, especially given the strong public market performance in Q4. A couple other items I'd like to draw your attention to on page 10 of the open materials. You've likely noticed a change to our commitment summary. Based on feedback from our IC members, we have added our closed commitments from the Future Initiative to our total approved amount. And we've also added our total approved amount for calendar year 2022 co-investments. And as Michael mentioned earlier, thinking about the year ahead, calendar year 23, with the vote to increase the target range from 13 to 19%, we sort of back into a commitment goal of $2.2 to $3 billion for the calendar year. I think, the treasurer mentioned, seems like there are more uncertainty in this market. There's more volatility in the variables. I think compared to prior years, we're going to take it 1 quarter at a time. And that's our plan for 23. Happy to open up to take any questions or comments about the markets or the portfolio.
Can I ask 2 quick questions, Michael? Of course. Yeah. So do you think, and of course you don't have a crystal ball, but do you think we'll see some sort of markdown, similar to what we saw in the public markets in 2022 and private equity going forward in 2023? That's the first question. And you touched on co-investments. We know how prolific they've been over the last decade or so. You see a real slowdown there, or maybe this could, I wouldn't say vanish from the landscape, but greatly reduce its presence going forward until there's a significant change in the landscape.
Yeah, thanks, Leroy. With your first question, I do wish I had a crystal ball. I might have to borrow Michael Trotsky's from his desk. If we knew that, it would make commitment modeling a whole heck of a lot easier. I would say there's, one, the publicly traded private equity firms have sort of announced kind of Q4 numbers so far. And, those larger buyout firms, you're seeing positive numbers for the quarter. I think that's an indicator, but very hard to predict as you know. And then remind me of the second question, Leroy.
Co-investments and their
co-investment. Yeah. 22 was a big change in the markets as we've discussed. And looking back, we were quite active. We were quite active in co-investing throughout the quarter. And you can see on the commitment page 10 of the commitment summary, approved co-investments of over 500 million. That'll be the second most. We did a little bit more in 2021, but what we found is the co-investing from our standpoint is really a function of the number of approved co-investment managers. That's probably one of the big variables. And I don't think the program's going to grow the way it has. We started from literally nothing in 2014, made our first investment in 2015, and we've been growing it incrementally. But I expect, to see deal flow in 23.
Thank you. So, Michael, I'm trying to, better understand the push and the pull, and maybe I misunderstood some of what was said. But on the one hand, some peers are overcommitted to private equity, and there's a lot of, you said it's crowded for fundraising. So it seems like a good time for the PRIT fund to be committing capital. Markets are down. Yeah, you talked about the uncertain environment. I guess I'm trying to reconcile what could be a great time to invest. Is it a great time to invest? Is it not? How are you thinking about it?
And I think, wouldn't the others having a overweight just be the denominator effect, where there's a lag in performance, and that's what's creating a situation where everything else went down for the year, and private equity not so much? So I didn't mean to interrupt here, Phil, but I just wanted a greater confirmation on the math that's going on there, not necessarily what's happening in the markets in terms of others being more active in this space, right?
Yeah, and it's hard to predict what other position people or other institutions will be in. Are they in a position to continue committing, continue investing? I'm not really sure. It's really hard, and that's not something that we're focused on, nor something that we can control. In terms of where we are allocation wise, is a confluence of factors to get us to get the 17.7%. If you look back historically, you'll see us growing that private equity allocation in part because we're committing more, and the portfolio has performed really well, especially in fiscal years 21 and 22. This past year, what we saw was a real slowdown in the exit market. So distributions, we measure it, distributions as a percent of NAV, really decreased. Within sort of historical ranges and estimates and, various scenario plans that we have run internally, but it was drastic. So that NAV stuck around longer than you would have predicted in a, quote unquote normal year. So it was a combination of those factors. And then, Philip, I think what was said earlier in terms of kind of staying consistent with private equity is really, really important. That vintage year diversification is absolutely critical to a long-term, successful program. And I think as we look back and we look at some of, PRIM's success, I think having exposure, to all the vintage years, because not only would making asset allocation predictions on valuation is difficult enough, but then doing it through illiquid commitments is even more challenging, because the commitments that you approve on one particular day could be not even activated for 6 to 12 months, let alone drawn down over the next 3 to 5 years. So predicting that valuation environment is really, really tricky. So instead, what we're looking to do is stay consistent. History will tell you that in a difficult time with valuations that are low, seems like there's more uncertainty, but that tends to be a good time to commit and to invest.
So I would just add that I concur with everything Michael just said. A couple things that I would add is that people, because of pacing, are finding themselves, with a lot of unfunded commitments, more than perhaps they expected, and that accentuates, when you sort of apply that, it accentuates against the fall in the NAV of the entire portfolio, and that's causing some to reconsider their amount that they can commit going forward, and I think that will increase the opportunity that PRIM has in this marketplace. And we're seeing that anecdotally coming from more and more managers now who are really seeking capital outside of their traditional asset bases because they have to.
Hey, Mike, is there enough pressure and fundraising to allow us to pressure some of these funds on contractual issues that have always bugged me, that are kind of unilateral and restrictive to our actions?
On the economic terms or on the governance terms?
Well, I mean, I'm certainly always interested in economic, but I was thinking governance as well.
I think environments like these provide more of an opportunity, certainly. But we'll be fighting those fights in the trenches, and I think we'll have some successes to share over when we look back at 23. But I wouldn't predict a wholesale change in kind of the structure of the industry. Phil, you might have you've got better perspective than I do on that.
Yeah, among the top tier firms, the most selective firms that you are really the only ones that you want to invest in, there's unlikely to be a lot of changes. If anything, there'll be changes around the fringe. Lower tier firms, there could be fairly significant changes just to get funded.
Any other, the overall comment I just am sitting here thinking is that reflecting back over the course of the last 8 years, clearly we're in a new phase of how we are going to have to look at, view, invest in, work with private equity. And I think a lot of that has to do with the disruptions in the markets and everything that we're seeing. So I feel confident, Mike, in your ability to evaluate and analyze this and proceed. But in the alternative, I also think as a fund, I'm sure Michael Trotsky, all of you are thinking about how long-term this affects our overall strategies, asset allocations, and potential returns. So since it is a change, I don't know if you want to comment at all on what I just said, Michael?
Sure. Let's not forget that even though things have changed, private equity is still far outperforming public markets, both fixed income and equities at this time.
It's just different. It's just a different world there.
And we are moving into a different world, but we've moved into different worlds in the past where private equity valuations have come back. And I think at least our conclusion at this point is that staying the course, continuing our commitment pace is perhaps the best strategy at least for 2023. We are increasing our target, and we're maintaining our commitment pace, which means that we have conviction that our managers are going to be able to buy private companies cheaply, and those private companies will still have an opportunity to do very well. So, the whole asset allocation exercise today was meant to underscore our belief and confidence in the long-term performance of private equity.
Very good. Okay, then, any other comments or questions about private equity or any part of the open session? And if not, I will now do the script to move into the closed session. How does that sound? All right, since I hear no objections, this meeting of the PRIM Investment Committee is hereby adjourned. After a brief 5-minute break, we will host remotely a limited attendance closed meeting pursuant to Section 23(6) of Chapter 32 of the Mass General Laws to discuss material or data made or received by PRIM, which consists of trade secrets or commercial or financial information relating to the investment of public, trust, or retirement funds, the disclosure of which would likely impair the ability to obtain such information in the future or cause substantial harm to the competitive position of the person or entity from whom the information was obtained. Persons attending the closed meeting received via email the Zoom and dial-in instructions to access that meeting. And that meeting will begin in 5 minutes, which means 12 noon after this meeting now ends. This open meeting will not be reconvened following the closed meeting. 12 noon, see you shortly. Goodbye.